Hi, I'm Max Keiser. This is the Keiser Report. The word of the day is magnitudes. Let's find out what's happening, Stacy.
Yes, we need to take a step back and look at the magnitudes. This is coming up in a tweet I'm going to read, but I also want to remind you that this is the week that set in motion the end of Bretton Woods, right? August 15th, which was a Sunday, 1971, President Nixon went on to live television in America Sunday evening and announced they were basically closing the gold window temporarily, they said. And then on Monday, the 16th, it came into effect. But on August 15th, he announced it. And now here we are 50 years later. Similar situation. Sunday night is August 15th. The 16th is that Monday. Who knows what might be in store for us? Maybe they're going to close, let's call it the Camp David window, right? Because we had Bretton Woods up until 1971. Then, since then, we had Camp David, essentially. Nixon closed the gold window. They had organized that from Camp David. So I'm going to call it the Camp David window that is being closed.
Could be the petrodollar window being closed because it replaced the dollar in the 70s.
Exactly. Something's happening. We don't know. We're going to continue covering this in the next week or two. But here is a tweet from Lucas Nuzzi. Take a step back and look at the magnitudes. Bitcoin settled the equivalent of $2.1 trillion in the first half of 2021. That is 10% of the US GDP.
Right. Well, we're heading toward a global Bitcoin standard, and fiat monies are going to disappear completely, not just because of inflation, but because people are using Bitcoin as a unit of account, as well as a medium of exchange, as well as a store of value. And these volumes in Bitcoin suggest that that's exactly what's happening, with El Salvador making it legal tender, Nigeria becoming Bitcoinization-sized. And the numbers speak for themselves. The magnitudinous quantity of these humongous numbers is not to be denied. It's like there's a huge meteor coming to planet Earth called Bitcoin, and the astronomers look through their telescope and they say, it looks freaking big. And people are saying, nah, it can't be that big, can it? And they're like, no, it's really big, and it's gonna hit. And once it hits, if you're not prepared, it'll be too late.
The whole time that we've been doing Keiser Report, it's been all about the magnitudes, because we've seen the magnitudes of the fraud, the magnitude of the volatility, the crashes, the magnitude of the asset purchases by the Fed. Now the extraordinary magnitude of the stimulus packages that have been deployed across the United States in the past year, but also across Europe and Australia, other parts of the world. Now we have, remember, we noted that the IMF during the election season last year in the United States, they dropped the notion that the IMF says that the world needs a new Bretton Woods, right? Well, here's some news out this past week, and Lynn Alden reported it. The IMF approved a round of new SDRs valued at $650 billion US to be credited to the reserves of member nations. She follows that up with, this more than triples the SDR market cap outstanding and is another small step towards a more diversified or multi-currency global reserve system.
Okay, this is the long simmering conversation on this show, going back years, going back to when Jim Rickards, famous author, writer of many fine books, had talked on this very show about the IMF and the SDR, the special drawing right, as being the currency that will ultimately absorb all of the bad debts on all the balance sheets of all the central banks in this huge roll-up. I mean, a $100 trillion credit facility that'll be funded by the SDR, the special drawing right, which is the currency of the IMF, would provide a huge bailout to the central banks, who provided a huge bailout to the Wall Street banks and banks around the world as a way to keep this Ponzi scheme going. So it looks like the timing is now, that Christine Lagarde is, of course, used to be at the IMF. She's over at the ECB, so she will be a willing participant in this whole in continuation of the global Ponzi scheme. The numbers are humongous. But for all the multi-trillions of dollars worth of money printing and the quadrillions of dollars worth of derivatives, remember the Bitcoin hash rate runs in the quintillions. So it's running bigger numbers. The humongous numbers of Bitcoin are 50, 60 quintillion calculations per second. That's the magic of it. That's the beauty of it, that no matter how much they can print, the hash rate will always be well ahead. And that's going to be a permanent fixture going forward until all the fiat money is vaporized and goes to zero, like it all does. But it'll all happen globally at once. And the ensuing phoenix of hard money lotus flower will bloom into our collective unconscious, and we'll see the face of God. As I'm predicting, before I leave this show, I predict our audience will see the face of God.
Yeah, so, these are just the sort of, chaos and signs of disintegration that start before any empire collapses. And when we look back in history, you could see it. It often happens at a fourth turning. It could be a coincidence, but research that. We've covered the fourth turning before. But I think it's also certainly when you talk about this roll up, we had essentially a roll up in 1971, August 15th, 1971, when the U.S. went off the gold standard. It was essentially a way to do it was a modern version of a blank slate. Right, so the debt jubilees that they used to have back in the days of Mesopotamia, where the new emperor, the new king, or the new ruler would just wipe out the slates of all the debts that the farmers and people owed. They would be able to start anew and start the economy afresh. So that's what happened in 1971. All the debts we owed, the trade imbalance to the United Kingdom at that point, just start with a blank slate. And now we're at the end game of this, and you're starting to see the edge, the disintegration of the fabric of the financial universe at the edge, when you see the magnitudes of money printing, the magnitudes of stimulus. That's the disintegration, that they're ready for a reset. They're already signaling it. They're telling you, the IMF is saying we need a new Bretton Woods. The World Economic Forum and UN are saying we need a great reset. So they've already been telling you and signaling to people. If you care to look, it's there. So I think whatever comes next, and it's probably a CBDC, a central bank digital currency, that they'll roll it up again, or possibly tied to an SDR, roll it up again, and we'll start anew.
Right. Well, going back to Nixon, so he basically had three choices. He could either A, the U.S. default on its sovereign debt, B, the U.S. would give Britain the gold that they owed Britain.
Yeah.
C, that there would be a soft default in the form of swapping the gold owed for paper money, the dollars. So he chose option C. They chose money printing. Instead of adhering to the rule of law, the covenants of a bond are the rule of law. And so Nixon decided to ignore the rule of law, as he had done many times in many other occasions. And he gave the Brits a big bag of paper money to settle the debt.
Yeah. And
this set the precedent, really, for modern central banking, because what did Alan Greenspan do in 1987? When the stock market crashed because of the speculation that had been going on using illegal program trading, they decided to simply come in and bail everybody out, and then that set the stage for multiple bailouts, the 2008 bailout, the bailout of the COVID bailout, and the ongoing bailout, the rolling bailout, and now the SDR is another bailout. That's just another bailout. Let's call it what it is. It's another bailout that destroys the purchasing power of that fiat money and creates a bifurcated global society of those who print the funny money, who, like Christine Lagarde, who are living at the top, and everyone else who's now the road to serfdom. That's the fact, Jack.
Well, if we're doing a roll-up, we're doing a great reset, we're doing a new Bretton Woods. The thing is, if they do a CBDC, part of the problem with the disintegration of this is not only does the United States and the corporations and households have too much debt, and much of the Western world as well, the problem is that the U.S. is not a big enough percentage of the global economy anymore. So there aren't enough dollars overseas. And the only way to get it in this system, I'm calling it the Camp David system, the only way to get it into the hands of other nations is through trade. So we don't have anything to export, and that's a huge problem. That was part of the Triffin dilemma. We had to send over all our manufacturing overseas in order to, sustain this system, but now it's at that end. But if we do a CBDC, we could just airdrop these digital dollars, these digital SDRs. Look, nobody had to trade with the IMF to create these SDRs. They just tripled, right?
Right, it's
Tripled.
like Ethereum. It's a pre-mine.
Yeah.
It's just a pre-mine junk fake currency.
Yeah, and so they could just magically create these out of thin air.
Totally.
It's already there with the SDR. Nobody has to trade to create these.
Right, but that's what the Fed has been doing for decades. They've been swapping bad debt on Wall Street for the money they print
Just
over there at the Fed. Domestically.
But now
this is the global version.
It has to go global.
Right, because all the central banks have been colluding for years, and they all have multi-trillion-dollar liabilities on their balance sheets that have no resale value whatsoever. So they need to swap those for SDRs. So the Fed and all these other banks will be collateralized by SDRs that will be printed by the IMF. And they'll claim that they're all worth 100 cents on the dollar, even though there's zero resale value.
And it puts another layer between you and the money printing center. The people at the top are further and further removed. So first we had, the U.S. Treasury and the states, they issued bonds, they printed money, the Treasury, the U.S. government was in charge of money, and then it was the Fed, put a step between you and monetary policy, and then if they go to this organization like the IMF, then it's another step removed.
Right. So it's a self-governance is further and further away from the day-to-day reality of people on planet Earth, in particular America, that claims to have a government buying for the people. But if the Fed is now completely controlled by Wall Street banks, and the Fed is now completely controlled by the IMF, which is a supranational organization that serves the globalists, as they're called, then the idea of self-sovereignty in America takes another huge quantum leap of subversion. Because you'll be paying tax, by the way, to this new global entity. You'll be paying state, local, federal, and global tax. It's already introducing.
It'll probably be like a transaction tax sort of thing. Like
okay.
if you want to spend, you need their currency, and they'll take a cut.
But they're already talking about a minimum global tax of 15% for corporations.
Sure.
So they're already introducing this idea of global tax. They pay state, local, state, federal, global tax. Okay, your combined tax rate, it will be 80-90%. Okay, that's not a working, functioning economy. That's a serfdom. You're on the click farm. You're clicking for protein pills. You're in the casino gulag, y'all. That's what's happening.
Wait for the galactic one, once Jeff Bezos and Elon Musk set up new colonies.
All right, this interstellar tax. Local, state, federal, global, interstellar tax. Thanks, Jeff Bezos and Richard Branson. Well, we're going to take a break, and when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Mark Valek of Incrementum. Mark, welcome back.
Hi, Max.
Mark, the entire German yield curve is negative. Wow. Greg Foss says this means that these bonds are now a liability and not an asset. Do you agree?
I do agree. This has been building over years, and the yields have been dropping, and some of these countries have been yielding negatively already since years. Germany, one of the major examples. And yeah, it's just, I think, basically probably the culmination of a 4-decade-long bull market in bonds, and basically a falling interest rate environment, which has been going on for long, could go on for somewhat more longer, but it can't go on forever.
How does the government explain this to the population, right? Because the population, do they understand what a negative interest rate bond is? And what's the justification for it that the government makes? These are government bonds to the people. How do they explain this?
I don't think generally the public cares a lot about the yield curve, but what they do care about is rising prices. And as so often, governments try to make the best out of the situation, even from a PR standpoint. When it for example, comes to real estate. Public is complaining, rightly so, that the prices are too high. Government often says, well, the good thing is the yields are so low, so you can go take on higher debt and use this debt to buy this overpriced real estate. So the second thing which government says in this relationship is, well, look at the yield, the interest rate payments which we have been saving. We've been doing a tremendous job fiscally in just financing our budget so cheaply. So the government takes this as a positive, but in reality, I think it's a net negative for the whole economy, because it disturbs and distorts the whole economy, and it disincentivizes savings and incentivizes debt.
You mentioned the yield curve is not on people's minds, but rising prices are, and we see inflation all over the world now because of money printing. And Germany is interesting, I would say, because they are almost uniquely sensitive to rising inflation. Historically speaking, this has caused lots of problems. Over there in Russia, of course, they're taking this problem head on by raising rates. They'll say, hey, there's inflation, we're raising rates, which is what central banks should do. In Germany, they're saying, we see the same inflation, but we're actually lowering rates. So there's a philosophical split here. And one, Russia seems to be in accordance with actual monetary theory and the history of central banking. The other, Germany, seems to be making things up as it goes along, Mark.
I think German soul is kind of torn in two, because on the one hand, yes, there is still this collective memory of inflation, and people are wary that inflation could come back. But on the other hand, there is also, I think, the sense of responsibility to keep up this unified Europe, and a part of this is basically keeping the Eurozone together, which then again, as a consequence, needs so Germany needs to subsidize Southern Europe, and therefore it needs to keep interest rates low, and so I think they really don't know how to handle this, and even the Bundesbank is spending over backwards to try to justify the new monetary strategy from the ECB, which then again basically allows higher inflation in the medium term, which they really didn't want to initially when they started the euro. So I think Germany is in a predicament, but they really have to go on with all these measures, unfortunately.
Now, you mentioned rising prices, and we've seen rising asset prices for years. We're now seeing rise in real estate prices and consumer prices now. And we also see a reaction in two asset classes, gold and Bitcoin. Bitcoin so far is up 249% year on year, whereas gold is down 10%. So another interesting split. Two safe haven assets, two inflation-sensitive assets. One, Bitcoin, up over 200%. The other, gold, down 10%. What's going on?
Generally speaking, Bitcoin is in kind of a monetarization process. So that leads me to expect a much higher performance, generally speaking, of Bitcoin than relative to gold. Having said that, what you bring up is really interesting. The market, on the one hand, is already discounting or talking a lot about inflation, but on the other hand, it's not really discounting the continuous inflation. So what I look at here, which leads me to this conclusion, is, for instance, look at commodity prices. They have risen significantly, but if you look at the curve, say for instance oil prices, it's oil is trading in a huge backwardation. So basically, the future oil price is currently discounting to be much cheaper than it's currently on the spot market. So I would say that would be one indication that the market really believes the general narrative of the Federal Reserve, for instance, or of generally of the central banks, that this inflation pop was a one-off and it's going to be it's going to go away. And that's, I think, my best explanation, honestly speaking, for relatively weak gold prices for now. But I think this will change, and I think over time, market participants will realize that inflation is a more permanent thing, and these prices will also rise again. The curve of the oil will rise again, and the gold price will continue to rise and will make new all-time highs.
Well, as we know, and it's mathematically proven to be so, that the only way to mop up excess liquidity in the system is to raise interest rates. And that's an indisputable fact. And the fact that they're not going up means that somebody at the Bundesbank is being very, very irresponsible. Now, Mark, this coming weekend is the 50th year anniversary of the Nixon shock when the U.S. closed the gold window. Your Twitter bio reads, "The current monetary system is not sustainable." So I guess you think it has been a disaster, but tell us what went wrong 50 years ago.
I think that's a very important date in monetary history for sure, and actually also with great implications for general history, and vastly underestimated. And it symbolizes the disintegration of the monetary system, the gradual monetarization of gold, which went along and happened over the 20th century, and finally basically got cut 50 years ago. And so this had all kind of consequences which you are regularly talking about. But I think what is very important and often overseen, and that's why I also talk about the unsustainability of the current monetary system, I think what actually took place is gold was demonetized, but it basically was replaced by debt. So we have a debt-based currency system, and that again leads all kind of aggregates, monetary aggregates, credit aggregates, debt aggregates to start to increase exponentially. And we should all be aware of, and we should all know by now, at latest, since this virus, where we all been confronted with exponential curves pretty extensively, exponential curves are not sustainable. And so I think this is also the reason why we are living in an unsustainable currency system, because we have exponentially increasing debts and exponentially increasing monetary aggregates, and this won't last forever.
Exponential increasing debt, exponential monetary aggregates, or exponential growth in derivatives, all euphemisms or synonyms for money printing. And once again, the only way to mop it up is by raising rates. So once again, the Bundesbank and the European Central Bank under Christine Lagarde are acting completely irresponsibly. Now, going off the gold standard was a solution to America's debt and trade imbalances. Doing so extended the life of the dollar by another 50 years. That's what we're living in now. But now central banks are turning to CBDCs, central bank digital currencies. Is the CBDC a state solution, some kind of bland state solution to all the debt accumulated in all those 50 years? Is it going to work, Mark?
I think it's just reaching another level of basically debasing the central banking currency. So it's just using new technologies to perhaps more efficiently inflate the system. And that's exactly, as I said, what the system needs. Basically, all these measures which the central bankers are taking are measures which which you need to perpetuate the system. So I think they're using this technology to try to perpetuate the system for a few years longer. Yeah, it may work for a few years longer, but we'll see. I think this decade is pretty a very important one, and I think in this decade the system probably will come to some kind of an end.
So CBDC, central bank digital currencies, are just another version of fiat money, which is just another version of money printing, and the only cure for that is to raise rates. And once again, we can say the Bundesbank and the ECB are irresponsible by not raising rates, and they're causing inflation, and they're doing a repeat of history. And for Germany, that would be a catastrophe, I would think. But hey, who's looking at history? We've got about a minute left, and then we're going to hold you over for a second part. But I wanted to get into something over there at the Bank of England. They recently published a report executing a bail-in, an operational guide from the Bank of England. Wow. Along with their plans for a CBDC, Mark, it seems that all your fiat money belongs to them. We've been so-called in financial repression since 2008. Does a financial oppression follow now, Mark?
Yeah, that's, I think, also a thought which has come up in the critical debate regarding CBDCs. It could be also seen as some kind of a power grab from the central banks, because they actually can circumvent the credit creation, which is now at the private banking sector. And so that's, I think, something which is kind of a power struggle between central banks and commercial banks, which is going on. Richard Werner, I think, has very interesting thoughts on that. So if anybody's interested, one should check out his thoughts on this, I think.
But we saw with Cyprus a bail-in. The bank in Cyprus, the bail-in during the 2008 crisis was they took money out of people's accounts, or they failed to insure money over a very minimal amount of money. They stole the money. But we're going to take you over to a second segment. For now, though, thanks for being on Keiser Report.
Cheers, Max.
All right, and that's going to do it for this episode of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Mark Valek of Incrementum. Until next time. Bye, y'all.